Hi there. In this video, we explain how the corporate interest restriction works and whether the £2 million exemption could benefit your company.
Okay, picture this. You're a UK finance director of a mid-sized, highly leveraged limited company. You're sitting in a boardroom reviewing your tax position halfway through the year, and you're looking at a net interest bill of about £1.5 million. Now, because you know the UK's corporate interest restriction rules have a $2 million de minimis threshold, you probably assume you're completely safe, right? Well, what if a short accounting period or maybe just a sudden foreign exchange movement has totally stripped away that safety net? By the time this actually surfaces, your aggregate interest deductions are restricted, your tax liabilities shoot up, and the opportunity to correct the position without penalties, it's simply vanished.
Welcome to this explainer on the corporate interest restriction, or CIR. This discussion has been prepared by the expert tax advisors at My Tax Accountant, or MTA for short. They're a fantastic UK accounting firm dedicated to helping businesses like yours understand tricky tax compliance and navigate those really complex HMRC regulations. Today, we're going to dive into a question that honestly haunts a lot of finance teams. Does that £2 million de minimis threshold actually save you? While a lot of people just assume this threshold is an absolute safe harbor, the experts at MTA warn that it's very often a dangerous illusion of safety. Let's break down exactly why.
Here is our roadmap for today. Number 1, the £2 million trap. 2, how the baseline restriction works. 3, hidden traps around foreign exchange. 4, the strict new 2026 penalties. And 5, exactly what you must do to protect your tax relief.
Section 1, the $2 million trap. Group rules and short periods.
This is something many taxpayers first discover when reviewing their tax position right at year-end, which is often entirely too late to make any strategic changes. The headline figure of the corporate interest restriction is this: £2 million. Under the rules introduced by HMRC to combat excessive debt funding, this is your annual de minimis limit. The theory here is pretty straightforward. If your aggregate net tax interest expense sits below this £2 million mark, your group can basically deduct the full amount for corporation tax purposes without any restriction. It sounds super generous, and for a lot of smaller businesses, it keeps them entirely out of those complex CIR calculations. But the profound danger here lies in how that number is actually applied.
Let's dismantle the biggest myth out there right now. The idea that the £2 million limit applies to each individual UK company. In reality, the £2 million limit has to be aggregated across all UK companies in your worldwide group. So let's say you have 5 trading subsidiaries here in the UK, and each one pays $500,000 in net interest. You might look at that and think, great, each company is well under the $2 million mark, but HMRC aggregates that across the group, so your total is actually $2.5 million. Suddenly, the entire group is pulled into the CIR regime. This frequently catches out individual subsidiaries that genuinely, honestly, thought they were compliant on their own.
And honestly, the trap gets even deeper when we look at accounting periods. You see, the £2 million threshold is strictly an annual figure. If your accounting period is shorter than 12 months, that threshold is completely prorated. For example, if your group undergoes a mid-year restructuring that creates a short, 6-month accounting period, your safety net is slashed right in half to just £1 million. If an acquisition results in a 3-month period, you only have a $500,000 allowance. Missing this pro rata adjustment is a hidden compliance trap that regularly penalizes growing UK businesses.
Section 2, how the baseline works. Calculating the restriction.
So what actually happens when you breach that threshold? Well, by default, you calculate your restriction using the fixed ratio method. This caps your interest relief at exactly 30% of your group's aggregate tax EBIT day. If your net interest exceeds 30% of your tax EBI, that excess is treated as a restricted amount, and that restricted amount is entirely disallowed for corporation tax in that period, meaning your taxable profits and ultimately your actual tax bill will immediately increase. To truly understand that 30% ratio, you really need to know how HMRC defines tax EBITDA. It is strictly a tax-adjusted figure. It is absolutely not the commercial EBITDA you see on your standard financial statements. Tax EBITDA means your taxable UK profits, adjusted to add back net tax interest, capital allowances, and amortization. So, if your business has heavily invested in plant and machinery and you've claimed significant capital allowances, your tax EBITDA is going to be vastly different from your accounting profit. That dramatically shifts how much interest you can actually safely deduct.
Section 3, hidden traps and FX. What counts as interest? So what actually constitutes interest under HMRC rules? It is far, far broader than just the standard interest you pay on a bank loan. It includes loan interest payable, finance lease charges, and debt discount amortization. But crucially, foreign exchange or FX movements on loan relationships are also fully included. A lot of people overlook this detail, just assuming that currency fluctuations are a standard accounting adjustment, but under the CIR rules, they are a critical and highly volatile component of your net tax interest expense.
Did you know that unlike consolidated group accounts, which often strip out exchange gains and losses, domestic UK tax calculations actually retain FX movements on intercompany loans? Let's say your standard loan interest is £1.9 million. You think you're safely under the $2 million threshold, but then a sudden currency fluctuation on a foreign currency denominated intercompany loan adds £200,000 in FX losses. You are now at £2.1 million. You've breached the threshold, and even worse, because compensating adjustments just aren't available for CIR disallowances, this can create a sudden, uncompensated dry tax charge. You literally end up paying real tax on money you haven't actually made, simply because of a currency swing.
Section 4. New 2026 penalties. Strict administrative changes.
Let's trace the timeline of these rules quickly, because things are shifting. The CIR regime was introduced back in April 2017. For a long time, HMRC was pretty strict on the administrative side, requiring groups to appoint a reporting company within 12 months or face invalid returns. They did recently offer a bit of a grace period, allowing retrospective appointments for periods ending on or after 31 March 2024. But listen closely. That administrative grace period is coming to a hard stop. From 31 March 2026, the reporting framework tightens significantly, and new, incredibly strict rules take effect.
And here is the immediate cost of getting it wrong under the new regime: £1,000. From 31st March 2026 onward, a strict £1,000 penalty applies if a group submits a corporate interest restriction return without having validly appointed a reporting company beforehand. Now, while £1,000 might not break a mid-sized company, the knock-on effects can be disastrous. Filing an invalid return can mean that vital elections and carry-forward reliefs are completely rejected by HMRC. That could end up costing your business exponentially more in lost tax relief.
To avoid that penalty, you absolutely must understand the difference in the compliance process going forward. Under the previous rules, you can notify HMRC of a reporting company, and that appointment would just roll forward automatically between accounting periods. You could even use a free HMRC online portal. Well, as of 31st March 2026, that all changes. Appointments no longer roll forward. You have to self-certify the reporting company inside the return for every single period. Furthermore, that free HMRC portal, it's closing entirely. You will be mandated to file using commercial software. The administrative burden is now placed firmly and quite unforgivingly right on the taxpayer's shoulders.
Section 5. What you must do. Protecting your relief.
So, how do we navigate this landscape? Here are the essential steps you need to take. First, do not wait until year-end. Monitor your aggregate UK group interest continually throughout the year. Second, ensure you actively appoint a reporting company for each specific period to dodge those new penalties. Third, get your commercial software in place and file before your specific deadline. And step 4, here's a professional tip for you. File an abbreviated return even if you are below the $2 million threshold. Doing so actually allows you to preserve your unused interest allowance. You can carry it forward for up to 5 years, protecting you against future spikes in borrowing costs.
The absolutely crucial point to take away today is this. The $2 million de minimis is a threshold, not a free pass. It is highly sensitive to your group structures, short accounting periods, and technicalities like foreign exchange. Don't let the illusion of safety cost your business. To ensure you're correctly calculating your 30% fixed ratio and to safely navigate the incoming March 2026 compliance changes, you really need expert guidance. We highly encourage you to reach out to the team at My Tax Accountant, MTA, for personalized advice that is strictly tailored to your company's structure. Finally, please remember that this explainer provides general guidance only. Every corporate structure is completely unique, and you should always obtain professional, tailored financial advice before making any tax or business decisions. Thank you so much for joining me on this explainer today. I'm going to leave you with one final provocative thought. Looking at your current group structure right now, are you absolutely certain your company isn't silently falling into the $2 million trap? Until next time, keep learning and stay compliant.